The Senate needs to stop bending to the will of Wall Street bank lobbyists and needs to stand firm on consumer protections within the financial reform bill. Some progress is being made. Just last night, Senator Dodd announced that he was dropping his amendment to delay implementation of Senator Lincoln's strong derivatives transparency, but much more needs to be done. As we move closer toward the House and Senate Conference Committee, there are some very important consumer and taxpayer protection issues that we want to highlight for renewed attention as we get another bite at this apple, so to speak. The House passed a $150 billion fund, paid for by the banks, to be used to pay for the cost of failed institutions. $150 billion fund left when this bill left the House of Representatives. Similar to a car insurance fund, if Goldman Sachs wrecks their car, they should have to pay into the fund for their coverage. The Senate has stripped out the fund and put in its place a complicated scheme where the funds to pay for the cost of an accident come from the chopped up pieces of the car that's crashed. I kind of want to have insurance on the totality of the car before you get to drive it. Don't tell me there'll be parts of the car left that somehow mitigate. That'd be an interesting car insurance proposition. Don't worry, I bought a nice car, and if some of it's left behind, that's what you're going to get. This new proposal doesn't hold big banks accountable. It forces a failed bank's competitors to pay for the cost of its failure and could expose taxpayers to paying for big banks' failures all over again. Independent and effective consumer protection agency. The Senate has placed the Consumer Protection Agency under the auspices of the Federal Reserve, which could put the agency under the whim of market philosophies of the Fed chair at the time. We should have an independent. The Fed, under free market ideologue Alan Greenspan, failed to act for years to act on HOPA protections, which contributed to the severity of the mortgage crisis. Congress needs to ensure the Consumer Protection Agency is free from political influence as the banking regulatory agencies. Each of the banking agencies enjoys political independence. We are insulting consumers if we don't give the agencies the same kind of independence. And now we're going to hear from a couple of my colleagues on the issue, and then we have a representative of consumer groups. Ellison.
Thank you, Mr. Chairman, and thank you for holding this conference. This is so important. Let me tell you, this bill, this financial reform bill, is as important as the health care reform. This has to do with our livelihood as Americans, and it's critical that we get it right. And so as the senators are taking up this bill this afternoon and this morning, it's important that they keep a few things in mind. One thing they must keep in mind is that proprietary trading is something that is a risk in the system, and it must be dealt with now. We don't need a study to find out what will happen if we allow commercial banks that have FDIC insured deposits go into the discount window, getting money that they then can use to gamble on Wall Street and things like credit default swaps and other risky things like that. This is something that doesn't need to be studied. It needs to be regulated, and therefore, when it comes to proprietary trading, we would urge the Merkley-Levin bill amendment, because it's so critical to take that risk out of the system so that average Americans can have confidence in the stability of our financial system. The other important issue is something where the House, quite frankly, swung and missed, and that has to do with the auto exemption. I have an editorial that I wrote already. I hope all of you guys get a copy and get those to folks. But the fact is that why should your credit union, your bank, and everybody else who issues loans have to make sure that they have issued fair loans, but auto dealers, they don't have to make sure they issue fair loans. They're not subject to the Consumer Financial Products Agency. They should be. They should be. And you know, whenever somebody goes into that auto dealer's office and they look at that shiny new car and they're getting their finances all taken care of, you know, a lot of times they're at a tactical disadvantage. Some folks will walk in already having talked to their credit union and their bank, but many people will not, and the people who don't should not be subject to a loan that doesn't have the scrutiny of the Consumer Financial Products Agency. And it's a basic matter of fairness. It's a basic matter of fairness. So I just want to say that these two issues are critical. I think that this issue, it's important that we get this thing right, and it's important that proprietary trades are subject to regulation and that we close the loophole for auto dealers.
Gentleman from Vermont.
Thank you very much. It is absolutely critical that we pass a very strong financial reform bill. It's important that it be strong and fair to consumers. It's important that it be protective of taxpayers, and it's absolutely essential for the growth of our economy. Two things that I'm going to talk about are, one, the dissolution fund. If you have the big banks that went to the casino and bet and won and took the money, but then when they bet and lost money and came to the taxpayer to bail them out at $750 billion, that can never, ever happen again. And the dissolution fund will make the big banks, not the small banks in Vermont and in Minnesota and in Illinois, it will make the big banks that are gambling finance their own failure, not the taxpayer. So we must have a very strong dissolution fund in the Senate bill, similar to what we passed in the House. That's absolutely essential to our taxpayers, but it's also essential to our small banks that have been doing the right thing, like Vermont banks, where we're making loans to people and small businesses that are about building the economy and creating jobs. Second, there is a good provision in the Senate bill, the Durbin Amendment, that's going to protect our merchants from rip-off credit card fees. So I commend the Senate for the Durbin Amendment. Our merchants pay the highest transaction cost to credit cards in the world. We pay $48 billion. And that is because the big banks and Visa, MasterCard have a monopoly. That's got to end. We've got to restore competition and give that benefit to our consumers. The final point of a major financial reform bill is to restore to banking its original purpose, and that is to lend money to business. Wall Street banks have transformed what they do from serving the economy, entrepreneurs, homeowners, families getting started by making loans to businesses that create jobs and build our economy, into a casino with the proprietary trading. That's not what banking is about. And if they're going to do that, it has to be at their own risk, with their own money, with no taxpayer risk. But fundamentally, what we have to have in this legislation is provisions and incentives that reward our community banks that are doing the right thing and hold accountable some of the big banks that have been doing such disastrous financial gambling with taxpayer money. Thank you.
Thank you very much. Now we have Mr. Dion Spencer. He's the Director for Legislation and Regulatory Policy from the National Community Reinvestment Coalition. And he's speaking on behalf of NCRC and the Americans for Financial Reform, a coalition of over 200 organizations.
Thank you, sir. I thank you, gentlemen, and all of your tireless efforts to strengthen financial and regulatory reform on Wall Street. On behalf of NCRC and the Americans for Financial Reform, I would just like to briefly say thank you to all of those who are continuing to work to strengthen the bill in both the House and the Senate, and the fact that it's going to have an opportunity to come back through conference, and maybe we'll have an opportunity to strengthen it more. Some of the issues that are key and central to my organization are preemption and the ability to have an actual independent consumer financial protection agency, not a bureau. We've kind of lost the fight for now on the preemption side, and I don't think it's right for the federal government to be able to trump state laws in regards to banking and financial services issues. These issues directly affect communities, and those communities are at the state level. And for the federal government to be able to trump those laws and trump AG enforcement of those laws, I think it's not a good deal. So hopefully we can correct those errors in conference. But mainly the Consumer Financial Protection Bureau that they have now, I think we've all seen how it's supposed to be independent, it's supposed to have this funding, it's supposed to have these abilities to promulgate these rules, but when you peel back the layers, it's still under the thumb of the Fed. And this has to change. Hopefully, we all will be able to work this out in conference again, and possibly even the amendment that Senators Reid and Durbin have in their back pocket. Hopefully, it can come to life. But again, I just want to thank everyone, and we have more work to go. There's still some time to improve this bill. And on behalf of NCRC and AFR, we just applaud those that are continuing that effort. Thank you. Thank you.